Welcome to Abidi Stock Market Learning. The beginning is most important. New traders' common mistake on candlestick patterns. In this video, we are going to discuss the common mistake done by the new traders on candlestick pattern. Move on to common mistake number 1. You try to find meanings in every candlestick that appears on the chart. A lot of time, market are noisy. Not every candlestick useful when thinking about the future price movement. Instead of looking at every candlestick, focus on the one where the price is currently traded near important support and resistance level. So first identify where you think this level are and start looking out for candlestick pattern. Move on to common mistake number 2. Your imagination is too strong. If you have to zoom in at the Japanese candlestick chart because you think you see something, there is probably nothing there. You don't have to try and assign a textbook label of the candlestick formation you see. Focus on finding evidences of strong buying pressure when you expect to buy, and evidences of strong selling pressure when you expected selling. Move on to common mistake number 3. Your imagination is too weak. Japanese candlestick pattern that are supposed to form after 3 candles may actually end up forming over the 5 candles. Just because the 3 candlestick pattern takes the 4 candlestick to form doesn't invalidate the pattern. The meaning is still the same. It is more important to understand the price action behind the candlestick pattern than to simply memorize its standard forms. Move on to the common mistake 4. You forget the forest from the tree. If you constantly just focus on the shortly time frame like the 5-minute chart without stepping back and trying to look at the bigger picture, your trade will tend to get blindsided. Try not to make your focus too narrow. Move on to the common mistake number 5. You don't wait for the confirmation. There are some candlestick patterns that are considered self-confirming, but many are not. Make sure to wait until the candlestick closes and is fully formed before acting on a pattern. Always wait for a right confirmation that the price is moving in the direction you're expecting. Move on to the common mistake number 6, chasing the market. When traders look at the chart, see the huge bullish movement, they will think how bullish the market is. The market is going too high, let's buy. When you buy after the price has made such a huge moves high, you will face a problem that where to put your stop loss. There is no price structure, no support, no swing low that can refer you to set up your stop loss. You end up setting a random stop loss on your chart, maybe 20 or 50 pips or whatever you feel like. Now, here are the things. The market doesn't care where your stop loss is. After the price makes such a huge advisement, it's need to take a breath. So the price will retrace or even reverse altogether. And when that happen, someone going to take profit where your stop loss is, and you will get stopped out of your trade. That's the mistake to avoid. When you see the price make a huge move, that is a strong signal that you shouldn't be enter a trade. It is too late because there is a where the energy has been expanded, so don't chase the market. Move on to common mistake number 7, trading candlestick pattern in isolation. For example, they look at the chart and think, a bullish hammer, it's time to buy. After all, the textbook and the course is saying that if you see a hammer, it means that the buyers are in control and it should buy. What is the problem with this? Again, a bullish hammer simply tell you that the buyers are in control momentarily, but it doesn't mean that the market have a high probability of going up, because you still must look at the current market condition and the context of the market. Move on to the common mistake number 8. Blindly memorize all the different candlestick pattern. Let's be honest, there are many varieties of candlestick pattern, possibly 100 of them. If you were to memorize all of these pattern names and meaning, you will simply burn out unless you have a very strong memory. Instead, ask yourself what the market trying to tell you, and all you need to ask a very two simple questions. Question number 1. Where did the price close relatively to the range? A candlestick pattern has a high and low, so ask yourself, did the price close near the high? That means that the buyer are temporarily in control. Did it close near the middle of the range? Then maybe it undecided. Buyers and sellers are pretty much on equal footing. Did the price close near the lows? This shows that the sellers are in control. Question number 2. What is the size of the candlestick pattern relatively to the previous one? You want to see if there is any conviction behind the move. Let us say you spot a hammer on the chart, but the size of this hammer is about the same size of that the last candles, or even smaller. It is telling you that isn't any conviction behind the hammer. On the other hand, let's say you have another hammer that been formed which is 2 to 3 times larger than the predicting candlestick. This tells you that this is a clear and a strong price rejection, and there is a conviction behind this move. That's how you read the candlestick pattern. You want to analyze the size of a pattern relatively to earlier candlestick as well. That's it for the video. You should take your time to understand all the concepts discussed in this video. Take your notes and go back from time to time to review the strategies which has been shared with you. Please subscribe to our channel and click on the bell icons to get all the notification for our upcoming videos. Please like the video and provide your comments if any. If you feel the content of the videos are knowledgeable, then please share this video with your colleagues and friends. Thank you for watching this video once again.